Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world. Today we're diving into a filing that's a bit like a financial variety pack. 3 different funds are bundled together, so hopefully there is something exciting amidst all the reports. MFS Series Trust XIII just dropped their certified shareholder report, and we're going to break down what it all means. Buckle up, because we're looking at how their diversified income, government securities, and new discovery value funds performed. We'll try and see what went well, what didn't, and if there are any red flags that might scare off investors. First up, the MFS Diversified Income Fund. This fund juggles a mix of investments from lower quality debt to government bonds, emerging market debt, dividend stocks, and even some real estate stuff. Let's cut straight to what everyone wants to know, the costs. For Class A shares, expenses came out to $93 for every $10,000 invested. This is roughly 0.89% of your investment. Remember, this is just direct cost. There are also indirect costs. This essentially means for every $100 you put in, almost $1 goes to expenses. For the year, the Class A shares returned about 8.52%. Not bad, but here's the kicker: the Standard & Poor's 500 stock index, which is what they measure their performance against, jumped 18.41% the same period. Another one of their benchmarks, the MFS Diversified Income Fund Blended Index, did 10.31% the same period. The report says that picking the right emerging market debt helped, but being underweight in real estate investment trusts, or REITs, and overweight in US government bonds hurt their returns. It seems like their choices didn't quite pay off as well as just tracking the broader market would have. Looking at the numbers, Class A shares with the initial sales charge only returned 3.90% over the last year and just 3.44% over the past decade. The S&P 500, meanwhile, brought in almost 13% annually over those 10 years. Something is not adding up when they compare themselves to the general market. The fund's portfolio is structured with 66.83% in fixed income, 32.3% in equities, and a tiny 1.4% in money market funds. Fixed income means bonds, and the equity part are their stocks. Digging into the bonds, they're spread across different credit ratings from AAA to even some junk-rated CCC bonds. Next up is the MFS Government Securities Fund. This fund sticks to government-backed securities, generally considered safer than corporate bonds, but also giving you lower returns. They are changing the market performance index from Bloomberg US Government Mortgage Index to Bloomberg US Aggregate Bond Index. The expense ratio is a pretty low 0.77% for Class A. The Government Securities Fund has a 1-year return of 5.23% compared to the index's 5.81%. For this fund, total management fees add up to $7,481,881, and it maintains a very high portfolio turnover rate of 195%. The turnover rate is a measure of how frequently assets within a fund are bought and sold, where a higher turnover rate indicates more frequent trading. A turnover rate of 95% means the value of assets sold during the year was almost double the total assets of the portfolio. Generally speaking, it could mean higher expenses for the fund. The portfolio is built mostly on fixed income securities, sitting at 98.9%. The credit quality is very high, where the fund contains primarily AAA or US government securities. Finally, we are at MFS New Discovery Value Fund. This one is hunting for undervalued small companies. The main benchmark here is the Russell 3000. The cost of A shares is $125 for every $10,000 invested. The fund reports a total return of 9.88%, while the Russell 3000 index did 17.53%. Russell 2000 value was at 7.58%. This fund is equity heavy with common stocks at 97.7%. A large part of the assets are in financial sector. While its 1-year rate is quite bad when compared to the general market, the statistics do show how it performed well historically. This table shows the average annual total returns of the class of shares noted for the periods shown, both with, if any, and without sales charges. It also shows the average annual total returns of a broad measure of market performance and an additional index that MFS believes more closely reflects the market segments in which the fund invests over the same periods. So what's the story here? It seems like the Diversified Income Fund underperformed its benchmarks because of some strategic missteps in asset allocation and security choices. The Government Securities Fund, while lower risk, didn't exactly wow anyone either. The new Discovery Value Fund is equity heavy and missed capturing the full upside as equity markets soared. MFS needs to re-examine how they are allocating the diversified income fund's assets and reevaluate their security picking strategy in specific segments. Maybe the higher management fees might start making sense if they actually beat indexes and earn money for their investors. On the flip side, there may be opportunities in having very high turnover in this new era. The new strategy may not have had time to bear fruits given the short period that was reported. We'll have to see if these trends continue or if MFS can turn things around. Keep an eye on those course and benchmark comparisons because it matters. XIII, thanks for watching. Decode more next time by liking, commenting and subscribing.